Good afternoon, everyone, and good morning to those of you joining us on the West Coast today. Segal Select Insurance would like to welcome you to today's online presentation, Segal Select's Annual Insurance and Benchmarking Update, 2013 a look back and 2014 a look forward. Now I would like to introduce your speakers. We have Mark Dobro, Vice President, Consultant, and Brian Smith, our Chief Operating Officer. Brian?
Liza, thank you very much, and welcome everyone. This is the first of the sessions for this year. And I was just, as Liza was introducing us, I'm trying to think of how many years we've been doing these webinars now. I think it's got to be like 6 or 7 years now that we've been doing these, and we're trying to do about 4 a year at a minimum. So this one we're going to look at what happened last year in our core products of fiduciary liability, fidelity bonds, cyber liability insurance, and employment practice liability. And I will tell you right now, I'll start calling that as EPLI. Saying employment practice liability insurance all the time is too much of a mouthful for me. But we want to look what happened and what's probably going to happen or what we think will happen in 2014. We always start with our benchmarking. We have looked at what happened in 2013. We have done the analysis. And on this one, we are showing you the average premiums among the various peer groups that we have selected. And you'll see those peer groups along the horizontal axis there, less than $1 million, equal to $1 million, and so on, going from left to right. And then we're comparing 2012 to 2013. And here we're looking at the average premium paid within each peer group and the change that has been made on a percentage basis year over year. And Mark, you and I were both talking about that one for equal to or greater than 20 million in 2012 that just seems to jump right off the chart, weren't we?
Yes, we were. It seems a little bit of an anomaly.
And we looked at it very briefly, and we have to do some more analysis. This may be an outlier. When we get into clients who are buying equal to or greater than 20 million, we're usually talking our large regional or national plans. Asset size start to dramatically change very quickly from maybe 1 billion to over 10 billion or over 50 billion or whatever the numbers might be within these plans. And therefore, even one plan can sometimes have a dramatic impact on what the average might look like. But I think, Mark, you and I both agreed what we do see generally in here is the market remains very competitive. For the most part, we're seeing rates come down.
Correct, with a little bit of hit being taken by our smaller funds.
Which kind of surprised us, that we thought the smaller ones would remain the very competitive area, but yes, these very small ones did take a little bit of an increase in 2013. Now, if we're doing a 5% increase on a $1,000 premium, it's still $50. It's a relative scale here, but we are very conscious of plan assets. This next one's looking at average limits of liability, and pretty much the same thing. It goes across the board, so that in 2012 we were seeing limits being decreased. In 2013, we're seeing some areas now that are increasing limits. No major changes here. And again, the larger limits are ones where we're seeing increased limits more frequently rather than decreases. I think this slide is the one that continues to capture my attention the most. For 2013, it's the 8th out of 9 years now that when we take a look at the average rate per million across the entire book of business, rates are coming down. And this is the 8th year out of 9 years that they've been coming down. So that, relatively speaking, it appears the fiduciary remains a very competitive marketplace.